Oh my goodness, what on earth is going to happen to the Fife property market? So here we are, Perry. I mean, you know, are FIFE homeowners really worried about the property market? I mean, the latest quarterly data might actually surprise you. You know, in the previous articles in the FIFE property market, I'd like to provide an insight, in this one especially, of the real story of what is happening to our local and national property markets, and address the misconceptions that some of the media have actually been spreading. Despite almost daily reports of the housing market of a housing market crash since September 2022, yes, we've had daily reports of this. The data shows that the UK and the Fife property market are gingerly doing okay.
It's what we're seeing.
So just let's dive into these stats then, and start with the lifeblood of the housing market, which is, it's not property prices, it's new properties coming onto the market. Perry, do you want to talk about this, about national, and then look at it? Have you got figures for local levels and that?
I think what's really interesting for us is that on the national level, 407,946 UK properties came onto the market in Q1 of 2023.
Yeah.
I think that's quite a substantial amount. And it's interesting when you compare that to the 7-year average in between 2017 and 2023, inclusive of 403,105 new properties on the market in Q1. Big difference. There's not much in it.
Oh, wow. So you're telling me that nationally, 407,000 properties came onto the market in the Q1 of 2023, but the 7-year average is actually 403,000.
Yep.
So there's a bit more come on, which is fine, because what does that tell us then?
I think that's a critical marker for us, isn't it, and a bellwether of how the property market is going. We often talk about, don't we, about actually necessarily it's not the amount that you get for your home, it's the amount of properties that are being listed and also transactions. We talk about a lot, don't we?
Yeah, because that's clearly the lifeblood of the property market. I mean, everybody's obviously concerned about the price that they get for their house, but when it comes down to the property market itself, it's really the health of the market is determined by the number of properties actually coming on and the number of properties sold against each other. What else do we have to consider then? I mean, well, what about if we had a situation like 2008, where the number of properties coming onto the market in 2008 and 2009 was actually double of 2007? So supply outstripped demand, and hence economics dictated that house prices actually dropped for that reason. And that was, I mean, doubling. That's 100% more properties actually came onto the market than the year before. Absolutely. In 2008 and 2009 compared to 2007. And for doubling the amount of properties actually coming on, we only had a 20% decrease in prices.
Absolutely.
We've got nothing like that now. We've got 403,000 in the first, on the average of the 7 years, against 407,000 actually come on for the first quarter of 2023. It's nowhere near it, is it?
It isn't anywhere near it, Jim. And I think what's really interesting about it as well, when you look at the 407,000 versus the 403, in real terms, that's 1%.
Yeah.
And we're talking about doubling versus 1%. Massive difference.
I never really thought of it like that. Well, it's the balance of houses coming on the market and how many will sell will determine what the property prices actually, what happens with property prices. That's the key here. What we've got to learn here. It's the balance of what's coming onto the market against what's selling. It will probably will definitely more than likely determine the property prices themselves. So how do you know we're heading actually for another house price crash as we did in 2008? Or maybe not as the case may be. You know, what's your thoughts on this, Perry?
I think firstly, what we need to look at is do Rightmove searches on your chosen property market and map the number of properties that are for sale every week. I think it's important if you're looking at property to have a look at that.
What we do all the time.
Which we do all the time, and that's what our stats are based on, and we talk about it often, don't we? So again, check out Rightmove, see what's coming on, see if you're seeing that decreasing or increasing. That's always a good indicator as to what's happening in the market. And I think that's why we do that Sunday night update, isn't it, Jim? Because that gives us a real insight as to what's coming on and what's selling.
Absolutely. The Sunday night update is essential for me to keep ahead of what I'm thinking and to basically see the health of the property market on a weekly basis. Mm-hmm. And then we'll look at it on a monthly basis as well. And I will even look at it on a quarterly and half yearly basis, just to look at the health of our local market itself. But these are the statistics as well for the UK nationally. So that's a really good bellwether, because a lot of people actually say England is going to have a fundamental problem, when in actual fact, this doesn't bear it out, does it?
It doesn't. And I think the quick and easy ways, as we've just said there, the first one is that Rightmove searching to see what's, how that is fluctuating. If it's positive or negative. I think the next thing to do as well, and we often do this as well, just so we get a flavour for it as well, is when you're in Rightmove as well, don't just look at the properties that have come on the market. Also search for properties that are included, which are kind of sold subject to missives. That's always a really good one as well, because again, that tells you what real stock is out there in regards to maybe how long the property's taken to sell and what is completing, and is that moving forward to transaction, which is what we always speak about, isn't it?
So sole subject to concluded missives, just for anybody who doesn't know out there, sole subject to concluded missives, which is STCM. It's usually in wee brackets at the end of a sold sign. You only see the sold bit, but you don't actually see the STM because it's really, really tiny. But this means, in other words, that the property is actually under offer, it's sold, but it's subject to actually going through and a bargain being struck. Now, that's the Scottish market we're talking about. That's how that works. English market's a wee bit different. It's almost like English market. You can just pull it anytime you want.
You can. When I lived there once, Jim, we actually had the furniture in the van and it didn't happen.
Wow. That's quite remarkable, isn't it?
Yeah, it's scary.
Yeah,
very
definitely.
Scary.
So what other things?
I think those two key indicators are really good ones. I think they're positive ones for you as an individual if you're looking to try and get a flavour for the market. You'll be able to see what's in your area, what's coming up, what is selling. And then obviously if it drops off that STCM, as we've talked about there, then you're seeing that it is concluding as well. So it's a real quick way for people to get a good guise on it, isn't it?
Yeah. And then the other one is the third ratio is the amount of properties sold to the amount divided by the number of properties actually listed in that time period. And that gives you a really good indication about supply and demand. And you're really looking for, ideally, in an ideal world, for the health of the property market, you're probably looking for 100%. In other words, 100% of properties that come on is 100% of properties actually sold. If it's going to be more properties come on and less properties selling, then that's an indication that it could be a buyer's market. If it's going to be less properties actually coming on and more properties actually selling, that's going to be an indication of a strong seller's market, which is what we've had for the last couple of years, isn't it?
Absolutely is. I think the ratio of the sold properties to available property as well, if that rises monthly, then it shows that the market's improving as well. If that ratio falls, then is the market slowing, and then it's better for others and not for some.
Yeah, essentially, I'd agree. What else do we have to consider then?
I think if you really want to deep dive it, and not everyone's into stats, I know you like a graph, Jim, but not everyone's into their stats. But if you do want to deep dive it, you could split the search into the property types as well. So we often talk about that as well, don't we? You can do it into semi-detached, detached apartments. You can also search as well number of bedrooms. I know when I was looking for properties, I just put in the bedroom number I was looking for, because there's no point in looking at anything more than that. Yeah. So again, people look at it in different ways. If you're selling and buying, as I say, you can put in detached, semi-terraced apartment, and that'll really help you judge the demand and also the supply, because this isn't just about buying. This is also if you're considering selling, you want to get a feel for what you're potentially competing in the market. This is a real good way for you to get a quick understanding to what else is out there. Yeah. Is it like yours? What is the price? Has it sold? How long has it been listed? So it's a good way for you to understand that as well, because it'll give you a good feel for how your property is going to go. And whether or not actually now is the right time for you to market and take that to your advantage. Yeah,
that's really it. I mean, next, looking at the house sales nationally, 276,482 properties sold, subject to concluded missives, in quarter one of 2023. However, remember the devil is in the data itself. The 276,482 properties had sold and subject concluded missives, and in quarter one of 2022, when actually 341,888 properties actually sold in that same time period the year before. So both of these years were exceptional. I'm getting mixed up, am I?
Yeah, I get mixed up.
My number. I'm getting mixed up on my numbers because I've got a number of numbers here. So what I'm trying to say is, yeah, okay. So 276,482 sold, which is not very good compared to the 7-year average, which is the 306,000. So 276 versus 306. But yet the average in quarter 2021, this is where I'm looking at my numbers, is 397,000 properties, and quarter one 2022 was 341,000 properties sold. Both these years were exceptional. However, compared to the quarter one of 2023, to the average, the quarter average of 17, 18, 19, and 20, a more reasonable 282,000 houses were sold on average. Okay, so that now makes sense, doesn't it? That really implies that we're going back to some sort of normality before the pandemic.
Absolutely does. And I think that that's the key here, isn't it? It's about that stability within the market and not necessarily some of the headlines that we see. And it's nice to have that stable market because a stable market generally is a strong one.
Yeah. What about looking at what's selling nationally by price band?
Yeah, I think that's important to have a wee look at. So again, we talked about that as well a little bit on the, well, you did, Jim, on the Sunday slot, didn't you, in regards to the averages of what we're seeing and what's selling. So I think what was interesting about that, though, is that nearly half, well, 44% of all the properties sold in the UK in quarter one of 2023 were at the 250,000 or less point. And actually, that totally mirrors what you said on Sunday, doesn't it?
Yeah, you can see it right here, can't you, in the graph? And unfortunately for TikTok and Instagram, you guys can't see it. But if you do want to see this graph, tune into FIFE Properties TV on our YouTube channel and you will see it straight away. But we've got it up there now. So this is actually quite interesting. Yes, you can see there over half, nearly half of 44% actually of the properties sold in the UK were actually 250,000 or less. So there's the 250 mark. Look at all that. And that's really what I was saying to most of my clients now, that, you know, it's easy to get wrapped up in all the houses are selling and they're selling so quick. But in actual fact, the majority is actually at the lower price point in the market. And when even if you go up further, if you only just go over a third of the homes, which is 36% that came onto the market in quarter in the UK in quarter one of 2023 were 250,000 or less. So let me just recap that and just say this to you in the other way around in what I've just said it. Only just a third of the homes, in other words, 36% of homes that came on the market in quarter one of 2023 were 250,000 or less. Yet 44% of properties in the UK in that same quarter, more actually sold at 250,000 or less. So we've got an imbalance in the price points. You've probably got a huge amount of properties actually sitting in the market at £250,000 and more compared to what's been sold, but we've actually got a lot less at 250,000 or less. So we've almost got a market which is split, haven't we?
We do, and when I think the really quick way to describe that for me is that at the 250,000 or less point, 36% of the homes in the UK were listed in quarter one, but 44% sold. So actually, there is an 8% swing there.
So we've almost got a boom in 250,000 or less in terms of the supply and demand, but we've got an equilibrium in the 250,000 and more in terms of that market. So we've got a mix in the property market right now, it's not a stabilisation right across the market. It's a boom in 250,000 or less. What do you think? What do you think actually causes that? Do you think this is a reduction in stamp duty? Because the English markets, you can get stamp duty reduction almost up to 250,000 and beyond. So I think that's exacerbated this position, isn't it?
I think that it has done. It's interesting though, isn't it, that that's the price point, Jim, because when we look at what we again see with interest rates, and people concerned about the rises of that, and then the mortgage changes, and now they're all available again on the market, that potentially you would think would impact that pot of people, because it's generally where your first-time buyers, etc., sit, or your upscalers.
Look at the revealing here. When you look at the blue on this graph, the blue is the new to market, the orange is the sale agreed. Now look how the blue is significantly lower in every price bracket, up to 100,000, up to 150,000, up to 200,000, up to 250,000, and then it starts to equalize when it gets to 250 to 300. So that's the supply and demand starts to equalize out now. And then when it gets to 300 to 350, there's a slight bit more supply than there was actually getting sold, demand. And then when it gets to 350 to 400, there's more supply than demand. In other words, 8.7 of these houses were at that price point, 7.9 sold. When you get to the 400 to 500, 11 versus 10, then 7 versus 5 from 500 to 600, 600 to 750, 6.2 versus 5. So you could see that there. So the upper end of the market, which is the 250 and above, is actually now, you're talking about probably at 350 where it's equalised and everything above 350. Now this actually turns on its head where I was before. Because remember I spoke about this before, to say that the market itself, up to 300,000, it was demand outstripping supply. 300,000 to 500,000 was equal, and 500,000 above was supply was outstripping demand. But now with these new statistics here, it's up to 250,000, and then it's 250 to 350 it's equalised, and then it's now gone from 350 down from 500 now down to 350, to the fact that there's now oversupply 350 and upwards.
Yeah. That's definitely what we're seeing there. I mean, the lower end of the property market and that values at 250 and under are definitely performing better, aren't they?
This has got a lot to do with interest rates though, isn't it? More than likely. Because finance is becoming a lot more expensive. Therefore, you know yourself, when somebody decides to buy a new home, they typically don't say, how much is the home? They usually say, how much can I afford?
Yeah.
And if you can pay £500 a month towards your mortgage out of your salary, then you immediately think, what can £500 a month or £600 a month get me in terms of affordability to buy a house? Well, it can get you this amount. That's generally how it's looked at. Whereas other people, the mortgage brokers tend to look, well, that's how mortgage brokers work, isn't it?
Yeah.
What can you afford each month? It's like you come along to them and say, I'm wanting to buy a £200,000 house or a £250,000 house. They say, well, what you got to put down? Well, that amount. Well, that's what you've got to, and that's what it'll cost you every single month. And you go, well, I can afford that, or I can't afford that. And then they go, well, what can you afford? Then they go there, well, that's the price that you can afford to buy at that, what you can afford every month. However, if you spread out the term to a lot longer on capital repayment, therefore the price every single month, the payments every single month will come down. Therefore, you could afford a house at a higher value. See how that works? I mean, for people out there, it thinks, oh, I'm just out of reach of a property I really want, but I can't afford the extra 10,000. Well, go back to your mortgage broker and ask them to consider, is it a possibility you can afford it if you extend your mortgage by 5 or 10 years? And then it allows you to get that repayment down to the level it's acceptable that you can afford, and then that gets over the line. I mean, that's a way to do it, isn't it?
It is a way to do it. And I think it's really important, actually, if someone's out there and they're looking at that, is not just necessarily to just jump ahead and renew with your current supplier. I think it's really important that you get a good independent financial advice on this from a good reputable mortgage advisor, because actually they have got so much else to offer that just one high street lender doesn't have, and it will help you with that.
Yeah, I would agree. I would definitely agree. So what about when we come to FIFE? How does it compare in FIFE then?
I think that's really interesting, actually. When we look at local stats, I mean, starting with the number of properties in Fife that came onto the market in Q1 of 2023, 1,548 properties came onto the market in that quarter.
Yeah.
The average price of those 5 properties coming to the market were 215,284. So sitting exactly in that pot that we're talking about.
And that's 17.2 for 90 days in the quarter. So if you take the 1,548 and divide it by the 90, which is the 3 months in the quarter, then you're roughly getting about 17. So every single day, 17 people in a Fife decide to sell their house.
Mm-hmm.
And I would assume naturally by that is 17 people decide to buy a house.
Mm-hmm.
Because you can argue that some people actually exit completely because they move somewhere else completely different and move out the area. But then you've also got first-time buyers that pick up that, and you could argue that as well. That they buy the house, but they don't sell a house. So I think there's an equilibrium there. And you were saying the average price of these 5 properties coming to the market was what, 215,000?
215,284. Yeah.
Again,
but interestingly,
that goes in line with what we've just spoken about, though. Everything under 250,000 actually selling.
Absolutely. But that's kind of the average price. But the price range band that saw the most listings was the banding between 100,000 and 150,000 range, where 368 out of that 1,548 that came onto the market were within that 100 to 150,000 mark.
Which is 24%.
And that's what you said about a quarter of the homes. But it's an interesting one when you look at that. I mean, that's the amount of properties in Fife that came on in Q1, but it's quite interesting if we look at how that's localised as well, Jim. So the breakdown of that 1,548. When we look at that, in St Andrews, there was 126 listed.
Okay.
Leven, 136. Glenrothes, 190.
Wow.
The East Neuk, 189.
Okay.
And Cooper, 117. So your East Neuk and your Glenrothes is really where your higher listings were.
That's actually quite surprising for East Neuk, considering that East Neuk's got a lesser population in terms of the other areas. And yet, what do you think drives that? Do you think it's maybe price? It could be the fact that it's exit, holiday homeowners exiting.
Could be, and we are seeing that. So could well be that. And the ones that are buying, moving in, certainly what we're dealing with tend to be people who want to make it their permanent homes. They're adjusting life and changing. Yeah.
And then they're selling, people make their permanent homes, but then tourism potentially suffers, especially in an area like that, because obviously that's reliant. It's maybe serviced accommodation, which is again what we've seen, because some people have actually been really put off by it. That's actually quite surprising and quite revealing, actually. So the number of house sales in Fife, how many was that then?
So properties sold in Q1 of 2023 were 1,472.
That's just a little over 95.5%.
Correct.
That's pretty healthy.
That's pretty healthy. And I've actually looked at that in regards to how that affects certain areas and regions of Fife. So out of the 1,472, if we look at St Andrews, 106 sold. So 126 were listed and 106 sold. So that was 92% sold of what was listed.
Good. Okay.
Yeah, if we look at Leven, 136 were listed, 129 were sold. So that's 95%. So healthy. Wow. If we look at Glenrothes, 190 were listed, 153 were sold, which is kind of surprising because that's 74%.
No, that's no surprise.
But we know why that is, exactly.
The new builds.
Yeah.
A huge amount of new builds. So there's a lot of people putting their house onto the market to sell it. But let me think about this. And then they're going on to buy. But then also you've got new builders. You've got new builds actually listing as on that that figure. So the new build people are in there, but they actually don't take it off as sold. So when you look at the Rightmove stats, it looks like they're skewed, and in actual fact they are. And it's because of the amount in there. It'd be interesting to look at them actually. I'll look at them later on. I'll maybe update on a Sunday night.
It might be interesting for you to try and see if you can get some.
And that's why Glenrothes is down at 74%, because Glenrothes is a really healthy area for house sales typically. But because of the huge amount of new builds, they'll get listed through Rightmove, but they'll not get sold through Rightmove.
Yeah,
okay,
exactly.
Well,
then we look at
East Neuk.
Yeah, so when we look at the East Nuke, 189 were listed and 168 were sold. So that's in at 88%.
That's okay. But remember, East Nuke's quite a high price point anyway. You know,
Correct. So you'd
it
expect
has become a wee bit unaffordable for people to actually stay in the East Nuke area.
Mhm.
I mean, I often joke myself when I go out to see someone and they go, "Where do you stay?" And I go, "Well, I stay," and I go, "I can't afford to live in the East Nuke."
But I think what's good about that though, Jim, is it actually is coinciding. If we look at that previous graph that you demonstrated there, that 88% in East Nuke sales is demonstrating actually that higher price point, isn't it, in that graph that we looked at?
Yeah, that's you're absolutely right, because that is the average price point is a lot higher, and
Correct.
that will indicate an oversupply and less demand. Yeah,
You would expect that. And then when we lastly look at Cooper, in Cooper 117 were listed and 109 were sold, so that was 93%.
Good.
So a healthy market all over, really.
Definitely. Average price point for the houses selling then, what was that?
So the average price of those 5 properties that sold were 192,609. So again, just on that cusp of that 200 point.
The 250,000, 215,000 actually for the average price of the properties coming to market.
Yeah.
Properties actually getting sold, 192. Now that doesn't mean to say that, you know, all the properties are going on for under what they're coming on for. That just means there's a different kind of mix in the market. But that's pretty accurate to each other, because 192 divided by 215 is round about 90% or thereabouts.
Yeah.
And that's okay as well. That's fine. What's the price bracket then? Here's an interesting one. Here's an interesting one. Can you look at the price, the bracket of the most sales for the price bracket? Because you said to me before, the price range that saw the most listings was between 100 and 150,000, where 368 properties actually were listed. What is that now and sold?
So what that equates to in actual sales was that the bracket with the most sales was the 100,000 to the 150,000 bracket. So the same bracket, where 394 properties sold in that bracket. So there was an undersupply, exactly.
Demand outstripping supply there. There's a boom. There's a boom in that particular price sector, isn't there? That's 107% in terms of demand. So basically, there's 7% more demand for that price bracket of properties than there is actually coming onto the market. So we can conclude for that, if you've got a property around about the 100 to 150,000, or maybe the 200,000, it should sell quite well. And anything above that should take a wee bit longer to sell, and anything probably above 250 should actually take I wouldn't say a lot longer. I'd say just in between a lot longer and longer to sell. I don't know if there is a word in between. But do you know what I mean? Yeah. It's like, and it's managing the expectations of people actually on the market right now and selling. It's clearly out there. If you're above 250,000 for your house, then it will take a lot longer to sell, and you'll more than likely get a lot less viewers than you will if your house was at 150 or 200,000 down. Because that's the price point that the majority of people can afford. Let me talk about the marketing pyramid, in terms of where you are, your audiences. So down at the bottom here, it's huge, isn't it? This is the up to the 100,000 mark. This is where your audience is huge for that type of area. And then as you go up in price brackets, you notice how the audience gets smaller, and then as you go up to the top. So as you've got going up to the top, we're almost at the stage where at the bottom, it's almost like that at the triangle, because it's not really a triangle. But when you get to the top, it's kind of like that.
Yeah.
So it's like this. Can I do that? Maybe people will see that. Where that's price and that's audience. Excuse my scribbly writing. Hopefully people will notice that. See that there? Your marketing. So that's it there. So that is the price as it goes up. See there? So your audience, you've got a huge audience down there, and you'll be stable all the way up to about 150 and 200,000, and then all of a sudden your audience starts to detract as soon as you go up in price, further up. So it's more or less like funny enough, it's like a house.
No surprises.
I just got a wee door on it.
But I think it's interesting.
That triangle is no longer that. That triangle is now a house.
It's definitely like that. And I think it goes back to what the earlier point we made as well, with the fact that banding at 100,000 to 150,000, what we're seeing there is it's typically your first-time buyer properties that are leading that recovery. And that's healthy. That's what you want. It
is definitely. I mean, although economic turbulence remains, the property market is gradually moving towards the pre-pandemic levels. The national sales agreed in this lower price band are unexpectedly recovering the fastest, unexpectedly, I would say. However, larger, more expensive homes for sale are lagging. 8.5% of listings in the UK in Q1 2023 were in the 750,000 to 2 million price bracket. Notice if you'll get a 2 million home here in the Fife area, but you do get them now and again. Yet only 6.4% of sales were in the same. 6.4% of sales were in the same band. That's what I talked about before when you saw the graph, the 8.5 versus the 6.4. So there's a clear imbalance at the middle to the top end of the market. I would argue even probably 2/3 of the way up that market.
Yeah,
there's an imbalance happening all the time. It's the bottom third of the property market, the £200,000 price point and 250 price point and down is where it's actually selling quite well. And it's selling really well in the up to the 100 to the 150,000, as you've said.
Yeah.
The average mortgage rates fell back to their peak last year, with the best rate for a 10% deposit for a 5-year mortgage right now at 4.6 compared to last October, which was 6.62. It's amazing how base rates have gone up to 4.25. And yet we're still seeing a 5-year fixed rate deal at 4.6. If you're out there and you're on a variable rate mortgage, it's madness. Get yourself into a fixed rate now, because the uncertainty it's about to unfold. And I mean, well, everybody else calls it uncertainty. I know what's going to happen. Base rates are going to go up to 5% still, and it's going to go up 1/4 point for the next 3 months, more than likely. Inflation's not going to come down as quickly as expected, and that's what's driving that forward. Unemployment is still going to stay almost at record low levels since for the last 40 years. Now, you'd be lucky if it'll get to 4 and maybe 4.5 at the very most, but that's still way below what the pre-pandemic level was.
Yeah.
So we've still got a full employment economy where everybody's still working and making money and paying for mortgages. The only thing that's getting dearer, effectively, it can get dearer, which will affect house prices, is the mortgages available. And that's the middle to the top end of the market area.
It's interesting, actually, Jim, because that's maybe why we're seeing such a big bit of activity and an increased activity in that lower banding at that 100,000 to the 150,000 mark, because those first-time buyers are thinking, let's get it fixed now, let's go now before anything changes.
And that as well, but then as soon as we put on a house about the 150,000 downwards, it's every man and their dogs on the phone. You put on something that's round about the 300,000 and upwards, it's like slow. It's like there's not that much activity in comparison. But that's why I say to people, if you've got a house valued at that, don't expect it to sell that quick anytime soon. Just trust me. That's why we tell you, put your house on the market now and test it and see where it goes. I used to do this years ago before home reports, because obviously the home reports cost you money. I used to tell people, look, just put it on the market. We'll test it to see if we can get that price point. And if we don't get that price point, it's a marketing fee. That's all it costs you. Now to do that, it costs you around about £1,000 all in to do it, and to just to test the market. However, 99 times out of 100, it comes in how you expected anyway. So your quid's in to get moving to your next place. So there shouldn't be any fear out of that. But home reports stopped me for doing that at that time. But now we're back at a point where I'm almost saying to people, you're probably better to test the market before you actually go to buy another property. Because if you go and buy another property and then put your house in the market and realise that you're not getting anybody through the door, look at the amount of stress you're going to cause.
Oh, totally. And we do come across that situation, and one of the favourite things that we hear, Jim, don't we, is that, oh, my house is beautiful, it'll sell, no bother. And then they go buy something, put an offer on something else, get it accepted, and then there's a huge amount of pressure there, isn't there?
Right. Do you know why they know that? Do you know why you get that? My house will sell, no bother. Because they listen to all their friends that have no idea what the housing market's like. They just look at the house and go, your house is absolutely beautiful, it'll sell, no bother. You go buy it. No, well, shut up then. That's what I'd be telling my friend. It's like, you know nothing about the housing market.
Seek a specialist.
It's your personal opinion. It's like, you may as well just go to Facebook and ask everybody if that's the case. And just get their opinion. You'll probably be a better opinion than the people around about you. Because unless you know about the housing market and what it's like right now and how it's reacted, nobody would have seen or foreseen a split market in terms of what we've just described now, where there's demand is outstripping supply for 250,000 downwards and 250,000 upwards. You know, supply is outstripping demand. And you can see that narrow equilibrium between 250 and 350. That's probably going to shorten even more. And I think we're going to have two different markets, two very different markets. I think we're going to have two very different markets. That's something estate agents, and all my time I've done estate agency, which is a lot of years, have never had to comprehend two very different markets in the same property market itself, because it's the different price points. And
there's a clear distinction.
Yeah, and it's driven by that market. Yeah, that's the word. Clear distinction is a great word for that. Interestingly enough, though, if you look at the rates for the 10% deposit for a 5-year mortgage back in January 2022, it was 1.64.
They were giving it away.
Wow. It's like, wow, 1.64, wow. And I'll tell you what, there is a mis-selling thing going on now. Anybody that's been sold, I wouldn't even say mis-sold, anybody that's been sold a 2-year fixed rate mortgage by their mortgage broker is now taking umbrage against that, because it's now coming up to fruition and it's now coming out to go into variable rate. And they're now realising that they should really have done a 5-year fixed rate deal. So some of them are actually going about, or these ambulance chasers, I would call them, they're going about now and saying, oh, maybe you should have been sold a 5-year fixed rate deal at the time. I think you've been mis-sold. Let's put in a claim. So I've seen that pop up. Have you seen that on social media?
I have seen that, but if all the KYC's been done right, then there shouldn't be any issue with that.
Yeah, there should be. I mean, you know, all the documentation will be there. They'll not have a leg to stand on.
I wouldn't have thought so.
So tell me then, what does all this mean for homeowners wanting to sell in this market?
I think it's absolutely imperative that you get realistic pricing when you're listing your property, isn't it? Because that's going to make the difference. And we've clearly shown the definitions there in regards to where your property might lie. And the distinction between actually one level to the other is quite substantial. So true pricing is absolutely imperative, I would say. In Q1 of 23, there have been 243,602 price reductions.
Wow.
On the 590,481 properties. That's like 50%.
Yeah, that is about 50%. That is, but remember, this is actually quite common right through England, because they work on a different market. We work on past performance. So in other words, home reports are done based on past performance of properties. In other words, possibly that valuation is out of date in terms of in comparison to the market value, the true market value. Whereas the English market work on the principle of the true market value first.
That's correct.
And then they'll come down to the normalised level. But I think we're getting to a point in the Scottish market where possibly the home reports are a lot higher now, and possibly they might have to accept a wee bit lower.
Historically, our market's always been, you have your home report value and you negotiate up. And as you say in England, you have your value and you negotiate down. That's just the way they are.
But then you can't. How could you have a 30% increase in the last 3 years and then keep saying to yourself, "I'm expecting more money than my home report"? How is that sustainable?
I think it's not sustainable is the first thing, but I think secondly, I think it's about managing expectations, isn't it? It's about making sure that you're having that open and honest discussion with your agent at the beginning, and the agent understands and can evidence to you what the property value is and what the expectation of the outcome will be.
So that then says that it's better to come to market at a realistic price.
Yeah.
Start when your property is fresh to the market. Then go to the high price and lose the initial honeymoon period, and then reduce it. Only for some people to wonder what was wrong with your property in the first place.
Yes.
That is a real train of thought. Some people actually, and I keep telling people, like, you know, and I get that from when I go to see people, they talk about, you know, that one round the corner that's been sitting with so-and-so, that's been on for ages. And I says, okay, but, you know, I know they've reduced the price because I actually see it, and I have a wee app on my browser. It shows me straight away Rightmove reductions. In other words, by date when they actually went down, the app actually shows it. Rightmove actually tells you there's a reduction, but it actually doesn't tell you how much it is. But I've got an app that actually tells me all that and when it was reduced and how much it was reduced by automatically. So I can actually see that in comparables when I go out. So I usually say that's typically down to that. You know, it's the fact that possibly it was wrongly priced in the first place. But there is an argument you could, you know, aim for the stars, hit the moon on the way down.
Yeah,
I mean, that can be a second strategy. But we're now getting to the point where maybe aim for the stars isn't the way forward anymore.
I think where you're at is it's about understanding how your property has improved in value. It's about understanding how you're going to market it. It's about having a partnership with your agent as well about what is the number we anticipate will be achieved and what are you going to do to market my property to ensure that I get that. And it's about having all those realistic discussions at the beginning, I think, is the difference in that, Jim.
Yeah. So the market is seeing stability and confidence returning as it recovers from the turbulent end of 2022. The pace of the market, the property market itself, had reached an unsustainable level in the last 2 years, which was on track to slow to a more normal level. And the reaction to September's mini budget, for example, accelerated the speed of the slowdown. That's all it did. People just went, whoa, wait a minute, I'm just going to fold my arms here and sit and wait and watch to see what happens. That's effectively what most people did. I remember that period. It was like for a 2 or 3 week period, everybody just sat in their hands. They just sat in their hands and thought, what, is nobody selling their house? Oh well, I'm just waiting to see what's happening. It's like, no, let's get on with it. This is see when things like that happen, that is the golden opportunity for a seller to get on with it. Because they've not got any competing properties. They don't. Nobody. I don't think everybody realizes out there when you put your house on, you're effectively competing against everybody else in that price bracket to attract somebody's attention and, more importantly, their money to buy your house rather than the other person's house at the same price point. So if you look at your price point right now and you compare it on Rightmove, for example, say you're at 300,000. You should go into Rightmove and say, what's 250 and what's 350, and compare in that list, in the area you are, your property to these ones that are on the market right now. And if you're sitting at 300,000, for example, and somebody's just come on at 280,000, and you're sitting going, I would buy that before I buy my house, then your house is not at the right price at that point in time. This has nothing to do with the home report at the beginning. It's nothing to do with the surveyor. They didn't get it wrong. They based it on historical information. This is what it's like in the market right now in terms of price point. But remember, only one person can buy that house. And once it's gone, it's gone. It's off the scale. It's out of the statistics. And then when you get rid of that one, you then look again and you think, okay, my house does look more attractive now. That's a great way to compare just to see where you are right now. Because we often, now and again, we'll do a review for that, wouldn't we? We just go in, we just look at that and we just say where we are right now and just say, okay, that's what you're competing against. You know, if you're okay, we'll just hang on because that'll get sold and then you'll be in with a shout as well.
I think as well, it's kind of smacks together in the facts that we're talking about. And when you talk about how it slowed to a more normal level, but the reaction to the September mini budget accelerated the speed of that slowdown. When we talk about the previous comment about the interest rates, it then was no surprise, was it, that in October interest rates went up to 6.62. So everybody, that's why even more so people just sat, didn't they?
Absolutely. I'm just getting a couple of messages here on TikTok. Would you recommend buying a house outright for 200,000 or putting down a deposits and getting several? This must be a buy-to-let investor, Gary. So I'll give you a big shout out. You know, I would still potentially, if the numbers work, Gary, I would be putting down deposits because you could live it let me just explain. We'll sidetrack this to now, just so this is a masterclass in property investment.
This is your favourite topic, Jim.
Just for the next 5 minutes, just bear with me and tolerate me. You buy a house outright for 200,000, okay? You rent that for the rest of your days, for the next 20 years, for 200,000. Now, you maybe make an income out of that, a really good income every single month. But while you're making an income, in the next 20 years, that property goes up in value. So £200,000 worth maybe doubles in the next 20 years. So you've made another 200,000 on top of the income you get from that property, plus the 200,000 capital appreciation. If you put deposits down on every house, if you buy, for example, say you bought, we'll give it an easy one, 200,000, that would divide up into 4, 8. That would be 8 houses, 25,000 down each, just in an ideal world. It will be different because you've got ADS and everything like that. But we'll just say 30,000 each out of that. So you could buy 6 houses, have a wee bit of change left over, like 20,000, and you could buy 6 houses for 100,000 each. So you've bought £600,000 worth of houses now. Now, you may make a little less income because you're paying interest on the mortgage, but in 20 years' time, you've now made 600,000 more rather than 200,000 because you've got £600,000 worth of property. I hope the pennies just dropped about what you should do, Gary. Because I know what I would do. Well, I know what I do anyway. It's that, basically. So that's what you do. That's what all the multi-millionaires and the billionaires do with their real estate down in London and everywhere. That's what the Queen does. Basically, leverages the position, looks after the ongoing costs of the property and servicing it, makes a wee bit of profit to reinvest now and again, or make a wee bit of money to themselves. But they rely on the capital appreciation over the long term going up in order to make that money. And that's how people become millionaires in the next 20 years, just by having a normal day-to-day job and just doing that on the side. Anyway, I digress. Let's go back to where we were.
That's fine. So we were talking about the slowdown, that came after the budget. So I think if we look at it, although higher mortgage rates and economic headwinds present challenges, many potential home buyers who were effectively sidelined in that fierce bidding war that we had over those last 2 years, Jim, have now found a bit of a slower pace. So the property market slowed for them. So it gives them time to plan and strategize for their next moves. And actually, traditionally, we're going into what is the kind of busy post-Easter house buying season, aren't we? So it gives people the opportunity to do that. So while the demand for quality FIFE houses is still healthy, if the asking price is above the current market, sellers may need to find different buyers. Yeah,
definitely, I would say so. Determining a realistic price is crucial, but not easy, is it? Many sellers look at similar properties on the property portals, just exactly what I said, but those prices may be overinflated. Remember, estate agents have more tools at their disposal, such as comparing sales prices for comparable properties and thinking about prospective purchases in the market for the type of property undervaluation. Although getting the price right, somebody actually asked me, how is it you can get your valuation is sometimes higher than the surveyor's valuation? Because I know what the current sales for that type of property are at this point in time, real time. The surveyor is going on the sales for that type of property, that same property, almost 6 months to a year ago, because it's now just been updated on the land registry. Why do you think the land registry or the Office of National Statistics put out information and it's 2 months prior to the day they put it out? Because they're concerned that they're not getting all the right data in to give an accurate picture of the property market. But when you look back to the 12 months before on that report, it's a completely different figure than it was the 12 months when they actually reported it. Because more transactions have actually come through. So this is why an estate agent sometimes gets a slightly higher valuation because they understand the market and they understand the real-time data than what a surveyor does when they walk in the door. And this is why some estate agents often have a lower valuation, because they don't understand the market. They're just relying on the surveyor telling them a number. and they're believing it. But they don't take account of any real-time data happening right now. Equally, it could work the other way as well. The surveyor could come back and say, well, I think your home report's a lot higher than what the estate agent's saying. And the estate agent's saying, well, you know, in this market where it's kind of declining, if it's declining in prices, you know, I would dispute that. I'm not saying this market is declining, by the way. I'm saying that's the flip side of that. So you have to have somebody that's very, very knowledgeable in that conversation and understands the whole market in terms of how it's working, and also the split that's happening between a huge demand for properties 250,000 and down, and a lot less of a demand for 250,000 and upwards, I would say.
Yeah.
So getting the price can be difficult. Revising it downwards quickly is essential. Sellers should actually ensure that the property looks better value for money than similar properties. This is what I talk about comparing, you know, just keep an eye on Rightmove in prime location and Zoopla. Zoopla is probably a better one to keep an eye on, to be honest, because most estate agents can afford to go on Zoopla. Very few estate agents can afford to go on Rightmove because it costs about 3 times what Zoopla costs to go on. So you'll get more houses on choices on the Zoopla websites than you do on the Rightmove websites, although Rightmove seems a bigger website itself, but it predominantly isn't. So ensure your property looks better for value for money by comparing it on the websites. If you plan to trade up, it's good sense to set realistic prices, as you will gain substantial savings compared to moving in the last few years. However, if you don't need to sell urgently, even becoming a landlord could be an option for some people.
Yeah.
Again, we can help that. If somebody wants to do that, fair enough. Nevertheless, homeowners turned landlords should consider the property that if property values do drift downwards in the coming 12 to 18 months, it may take a few more years after that to recover to see those values seen last year, for example. I mean, we are in Fife probably back to last 6 months ago. Maybe September 2022, is that about accurate?
Yeah, I'd say about accurate we're there. Mm-hmm.
So what's your final thoughts on this then?
I think my final thoughts are whatever the rest of the year brings. Moving home should mostly be based on your circumstances. We talk about this often, don't we? It's not solely what is happening in the property market in Fife or the UK. It's what's happening in your life, isn't it? And we often talk about that. People move for what's happening in their lives. Their circumstances could be changing. It could be that they need to downsize for one level living. It could be they're getting married and they need a bigger home. It could be a child's on the way. There could be separations. There's reasons that are happening in people's lives that make that possible. And put that demand on them that they need to buy and sell. And I think that's what you have to do. Go when your circumstances are and try not to get too tangled up in the web of understanding of some of the other items that we spoke about, because it doesn't work for everybody.
We talk about this all the time, about your house isn't really to make money. It's actually just to stabilise yourself in the property market in terms of trading up and trading down. That's all it's there for. The only way is like what I talked about, it's property investment, which is a difficult proposition just now, considering the way the Scottish government is treating property investors. But that's another story. Anyway,
that's a different show.
Yeah. Thanks very much for coming on the show, Perry. I really appreciate it. And until next time, guys, it's Fife Properties TV. Bye-bye for now.
Take care.